At some point over the last few years, investing stopped feeling like analysis
and started feeling more like watching a game show. A very expensive, slightly terrifying game show.
Because honestly, it's been pretty entertaining. It's hard not to smile.
When someone turns a weekly options trade
into a completely ridiculous gain.
and immediately posts the screenshot.
Like they just unlocked the capitalism speedrun.
But while it's fun to watch, it's also deeply unsettling.
because markets used to feel anchored to reality.
Earnings.
Economic data.
The boring adult stuff.
And sure, markets have always had manic phases.
Large cap stocks in the 70s.
Internet stocks in the early 2000s?
Banks in 2008.
But eventually, fundamentals showed up. Like gravity.
You could ignore them.
Mock 'em!
Post memes about them.
But sooner or later, intrinsic valuations mattered again.
Because value investing sat at the foundation.
But lately, something feels different.
It's not just high prices. Markets have been expensive before.
It's not speculation either.
Speculation is basically tradition. What feels different is how loose prices feel.
Like fundamentals and prices.
But not on speaking terms anymore.
Because since 2020,
Like, didn't just react.
The markets didn't just react.
The pandemic didn't just shock the markets, it rewired them.
The story used to be simple. Invest long-term.
Buy quality companies.
At fair prices.
But then the narrative shifted.
Now it became.
Buy the dip.
Because stocks only go up.
Not because it hasn't worked. But because it has.
What used to be strategy quietly became assumption.
This shift didn't come from nowhere.
New investors flooded in.
Interest rates collapsed.
Liquidity exploded!
And markets adapted.
Every dip became a gift.
Every crash became opportunity.
But here's the uncomfortable part.
This didn't just affect retail investors.
It affected professionals too. When markets stop behaving logically,
Experience stops being advantage.
And starts becoming liability.
Because fundamentals stopped leading.
and psychology took the wheel.
This is where behavioral finance enters.
Traditional finance assumes markets are rational. Behavioral finance assumes markets are human.
Driven by fear! Greed!
Herd mentality.
And recency bias.
Yo! Woo! Nice!
These forces always existed.
Information moved slowly.
But today, everything is instant. News doesn't spread over months anymore. It spreads over hours.
And reactions happen even faster.
You can wake up,
See a hot stock tip online?
And deploy capital before brushing your teeth. Narratives travel at light speed. And markets move with them.
When enough people believe the same story,
Prices move.
even if fundamentals disagree.
Because attention became fuel.
And volatility became entertainment. This forced institutions to adapt.
They still model cash flows.
Discount rates. Valuation multiples. Here we examine the price-to-earnings ratios across different companies and industries over time.
But now they model sentiment too. Online narratives.
Social momentum.
Because these variables explain price action.
And that's how we got here. So the real question becomes,
is this just another bubble?
Markets have done this before.
Psychology overpowering logic. Narratives overpowering numbers.
And eventually, gravity returning.
Is this a structural shift? Friction disappearing.
Participation exploding.
Information accelerating forever. If that's true, markets may no longer just price cash flows. They may price attention.
and narratives.
So yes, markets feel strange.
But maybe the real question isn't why,
but whether this strangeness is temporary.